Hello and welcome back to Trust Issues, a podcast from Kepler Trust Intelligence. Before introducing this week's guest, a couple of points. One is that this was recorded about 2 weeks before it's going out, so some of the figures may be a bit off, so please check those if you're unsure about them. And the other one is your reminder that none of this should be construed as investment advice. Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. And with that, I hope you enjoy this episode. Hello everyone and welcome back to another episode of Trust Issues, a podcast from Kepler Trust Intelligence. This week I'm joined by Nick Greenwood. Nick is the manager of Migo Opportunities Trust, which is an investment trust that invests in other investment trusts. So it's like a trust of trusts, if you can call it that. So Nick, perhaps a broad question to get started with. Why investment trusts?
Well, I mean, it's a purely British thing, and they date back, they predate open-ended funds. But I mean, the important point is that unlike open-ended funds, the price you pay or receive depends on the equilibrium of buyers and sellers in the market, and that means on some occasions you can find that the shares are trading at way above the value of the underlying portfolio, more often well below. And we're basically looking for mispricings. We're trying to buy stuff at the wrong price, and where we can see a catalyst for change. And at the moment, I mean, investment trust discounts have been particularly wide in recent months. And I think on our last presentation, the average discount in Migo was about 28%, just taking the top 12 holdings. So lots of opportunities. Technically we're a trust of trusts. We absolutely are, but the reality is we're a special situations investor. We're seeing things that are misunderstood, they're unloved, and they're overlooked. And as I said before, we're just trying to buy them at the wrong price.
Great. And so I think over the past 12 months or so, I know your colleague, Gervais Williams, has long thought that there's going to be a sort of sea change in markets with a big debt bubble coming to an end, which does seem to be happening. So how do you think do you think that that's going to cause some sort of change in the investment trust sector as well? I mean, I think you've said before, I think that it's always gone through changes in the past. So maybe you could talk a bit about those and then what you think the future holds as well.
Yeah, I mean, probably the changes first. I mean, the sector has been in permanent evolution. I've been doing this since the late 70s, which is quite frightening. But I've always been told that the investment trust is a dying sector. But I think we're down to something like our last 42 billion because it keeps reinventing itself. When I first started, it was more of an institutional market. Institutions used investment trusts to get exposure to parts of the equity market they didn't do themselves. Then in the 2000s, it was really the home of the private client stockbroker. Today, it's evolving in two fronts. The ownership is increasingly private individuals, self-directed investors are becoming much more interested in the sector, and also the expansion comes because the world is looking at alternative asset classes. Be that song rights or space or aircraft leasing or renewable energy. And those things are just very difficult to operate in an open-ended fund. It's very difficult to sell an office block within 24 hours and meet a redemption. And we've seen what the problems are with illiquid asset classes being open-ended with the property funds, because they always seem to have vast cash buffers on the way up. So they're getting enormous cash drag, typically only maybe 20% in cash. And then when the markets start falling, they very quickly get gated. So the way around this is a closed-ended fund where people can come in and out via the market, and they get a price, and they know what the price is. It may not be a price that particularly appeals, but as the market and as investors are looking more at these alternative asset classes, we're seeing an enormous growth in what's available in the closed-ended sector. The second part of your question there was, where we see markets. I mean, we had a couple of years post the COVID pandemic where there was an enormous amount of cash pushed into the system, and we were very long in Migo on markets at that point. What we're going to see now is that a general tightening, and therefore, as money is sucked out of the financial system, there's less cash sloshing around to support asset prices. So you should expect markets to be slightly backwards. I'm probably not as bearish as my colleague Gervais, but you don't particularly want to be too close to the indices because, notwithstanding the fact we've had a few nice days, the general tide is against you.
Yeah. You mentioned that you've been doing this since the 70s, but a lot of managers in the investment trust space, in the financial services industry as a whole, myself included, have effectively only worked in an environment where super low interest rates, everything goes up, and that world seems like it's coming to an end. But there's lots of people who have no experience of anything else. So does that pose any problems for you or any opportunities as well for you as someone investing in trusts?
I think it's an opportunity because we've worked in these sorts of environments in the past, and as you say, somebody could be quite senior now and until recently had barely seen an interest rate rise, let alone a market crash. So there's a lot of inexperienced investors. I think that's less of a problem having had the COVID crash because they've now experienced a sell-off, and sell-offs happen for all sorts of different reasons. So 1987, for example, was just exuberant markets losing all they'd gained and actually ending up slightly up on the year, but it's still seen as the Black Monday and a great crash. So they all happen for very different reasons, and the next crash will happen for a different set of reasons. So I think the inexperience of investors is less of an issue than it was pre-COVID. I mean, the market scenario of just generally going slightly sideways to lower for an extended period of time actually suits us because we're finding all sorts of interesting opportunities that I've just found in nooks and crannies in our market, because with the markets just going up 20% every year, and we've managed to find all these mispricing opportunities, and although we'll have taken a lot less risk in achieving the returns, we're probably not going to be vastly different from the market, and therefore everyone will just say, so what? So in a slightly sideways to falling market, what we can achieve actually looks quite good. So the scenario on a relative basis anyway is ideal for us.
Yeah. So, I mean, maybe could you elaborate a bit more on that last point? So I think something that actually the last guest we were discussing was effectively whether if you look at the past 10 years or so, it's been very difficult for lots of managers to beat, I don't know, the S&P 500, for example, just because you've had what I mentioned before, so ultra low interest rates, lots of money in the system, lots of debt, and so on. So do you think, at least in the short term, or perhaps even longer term, there is more opportunity for active managers to outperform just because there won't be a sort of rising tide lifts all ships type of macro economy?
Yeah, I think that's absolutely the case. Although we've always been saying it's a stock pickers market, and it hasn't. It's really turned out to be that way. But no, if you look at the indices, particularly in the States, for example, the very largest stocks. I mean, the graph looks very different now from one that includes the mega tech stocks, which have been under pressure. So, and it's been very difficult, particularly in the US. Where there's sort of half a dozen stocks driving all the move, it's very difficult to outperform in those conditions because you've got to have big bets on what's going up just to even stay with the indices. So yes, I think we've moved on from that phase, and people who do traditional stock picking, finding interesting ideas, doing it in the and not relying on different numbers on the Greek alphabet. Will come to the fore, having had a very frustrating time for some years now.
And I mean, to change tack a little bit, I think one thing you touched on earlier was basically that you look for, I suppose, inefficiencies in the investment trust space. Can you talk a bit about how you go about doing that? I mean, you invest in lots of different things, is my understanding.
Yeah.
So is there a sort of overarching strategy or way of thinking about investments that you can apply to all these different funds?
I think, as I say, we're looking for mispricing. We do seek to get enormous diversification, and we'll have an enormous number of asset classes in there. That happens naturally, but that's something that we seek because it sort of reduces the volatility of the performance. I suppose we talk to a lot of people, and we're generous, and so a lot of our, for example, in the last few days we've looked at uranium. Lending to pharmaceutical companies, aircraft leasing. You're looking at a lot of these interesting areas and trying to assess what the portfolio could be sold for. And the reason so many pricing anomalies have started developing now that the trust world is a home for alternatives is that the net asset value that's published for an alternative is actually quite subjective. Unlike when the trust sector was populated largely by long-only equity funds, the manager can run the Bloomberg, and you get an NAV based on the closing prices of the previous day, and that's a fair call to what the portfolio is worth. With an alternative, either it's stale or the methodology doesn't really work as well as it did when the fund was launched. You can get a situation where the net asset value that's published is quite a long way away from what the value of the portfolio is, and simple example of that would be forestry. A couple of years ago, we owned a trust called Taunus Timber. It was a big beneficiary of the banning of the felling of natural timber in China. Most of its assets were New Zealand, which was a great place to export to China from. But they only revalued the portfolio once a year because it's an expensive exercise. And I think, from the top of my head, that the NAV was around 50p, the share price was around 40. The sea change in the timber market probably put the NAV up to about 65, but the market still stuck, because there'd been no change in the NAV, the market treated that NAV as verbatim, and the shares still traded at around 40p for some time after this sea change event. In the end, an Australian hedge fund made a hostile takeover for the trust, and probably got the assets very cheaply. I think 52p, I think it was at the back there. And all that happened there was the NAV had become stale. And we're just looking at where that market is now, and there's a big divergence there. The value of that portfolio would have been a lot higher than the stated NAV. Another more topical example: flats in Berlin. We have a holding in a trust called Phoenix Spree. It was always set up, I think, probably some years ago now, as a rental landlord, and then the methodology uses the rental value of the flats when it's publishing an NAV. But Berlin is a highly regulated market, and that's created a bit of a barbell valuation in the two identical flats, one with a tenant, one sold into the private market, will have dramatically different valuations. And the trust is going through a process of slowly splitting up a lot of its apartment blocks and selling them off as individual apartments. Of course, the price to get for that will be vastly higher than the valuations of those flats that's going into the NAV. And that's just a case of the methodology has become stale. It made perfect sense in 2005 for that to be the methodology, but the world has changed, the methodology is still the same, and therefore it's always going to produce an NAV which is well below what you can actually sell that portfolio for. So those are the sorts of things you're looking at. There always has to be a catalyst as well, because you can buy into something that's on a 30% discount, but if there's no catalyst, then it's going to stay on a 30% discount. So we're looking to see what could change that. In the case of Phoenix Spree, it's just a slow liquidation of the portfolio at a much higher rate or a much higher valuation than the book value.
I mean, I actually think that most people listening would probably expect at the moment for it to be the reverse of what we're talking about, where perhaps the valuation hasn't reflected an increase in, say, the discount rate, and thus maybe the NAV should be lower than it actually is. Do you think is there anything like that happening at the moment as well?
I mean, if you were to look at property at the moment, they're trading on very steep discounts. In Phoenix Spree trades on an enormous discount of over 40%, and that to a certain extent is factoring in that the NAVs are going to fall. But of course, in the investment trust world, the falls have already happened, and they've probably overdone it. So the NAVs are going to come down, but probably nothing like as far as some of the share prices have come down. And that's because there's uncertainty about what the cost of capital is going to be. We're going through a change in the environment, and we're going to have higher interest rates. Quite often when there's uncertainty, share prices just keep falling and falling, and tend to overdo it, because until people can actually quantify what the damage is, and it's still uncertain, they can't get their calculators out and work out what the true value is, and therefore, in the absence of the certainty of bad news, prices fall. So that's a good area where, yes, the NAVs are going to fall, but the share prices have fallen dramatically more. Another area is private equity, where we'll be getting some valuations coming through, which are given debt is central to the structuring of a lot of those deals. The second-hand value of a lot of those transactions must be lower than the ones that they're publishing at the moment. But again, until recently, they were trading out on 40% discounts in some cases. So the damage is, the damage in the falling NAV is not as high as the fall in the share price. So yes, it's all a moving target, but certainly in those two sectors, for example, we would expect the next couple of NAVs to be published, the next couple of quarterly NAVs to be steadily downwards.
Yeah. So do you think in that case, there's it's almost like the current discount is not necessarily wrong, but it could act almost like a cushion against further drops? So if, as you say, NAVs come down, it's basically already priced in to some extent.
Yeah. No, I think that's right. I mean, the property sector, has priced in, very, very steep falls, which may or may not happen. It depends. I mean, the area that's vulnerable there is some of the things like the big boxes that became perhaps overvalued, and therefore the cost of their debt will be higher than the yield on the underlying portfolio. So obviously those have got an issue. Phoenix Bree, as an example, well, the portfolio or the underlying yield is probably just shy of 3%, but German bunds the yield has dropped back to 2%. So at least there's a positive carry there.
I mean, that's another point that I think investors are increasingly having to be aware of, which they haven't had to be for quite a while. Which is, if you're a trust and you're using gearing or whatever it might be, you finally really have to factor in the cost of debt. So is that something that you've also had to sort of change the way you look at things over the past?
I think we always looked at it, included that. We like to build a portfolio that's not got a lot of debt in it. And if you lived through a few crashes, you can see that when you've got debt, things happen rather quicker than they do when you don't have debt. I mean, but obviously we have exposure to property and private equity where debt comes with it. But there are certain areas and certain structures that that are quite geared that we would avoid.
Okay, and maybe to go back to a slightly different area. I mean, I think most of what we've just talked about now is really focusing on alternatives.
Yeah.
But if you were looking at, say, a just classic long equity, doesn't matter where it is, it could be a country specialist or it could be global. Are there any other, at the moment, are there any things that are happening which would create the sort of inefficiencies that you're talking about? Maybe just pure pessimism or something like that?
Yeah, I think so. I mean, for example, the Vietnamese market has been extremely weak, and the trusts exposed to that are on quite high discounts. I mean, there is a legacy there. I mean, Vietnam briefly in around 2005 was one of the most fashionable investment destinations on the planet, and the number of closed-ended funds that launched raised insane amounts of money. So, the special situation element, and we would like there to be a special situations element in things we buy, is that there's a massive oversupply situation, because the legacy of those insane amounts of money that were raised all those years ago has led to the two trusts that we own, for example, being FTSE 250 constituents in their own right, absolute dwarfs demand for Vietnamese assets. So there's more stock around than there's demand, and therefore that's why you have a wide discount, because the share price, where buyers meet sellers, is a long way below the value of the portfolio. The catalyst there is that the boards of both of those trusts recognise the oversupply situation and are buying back quite a lot of stock for cancellation. And we think that Vietnam, being a beneficiary of the sort of COVID lockdowns and the need for the multinationals to diversify their manufacturing, their supply chains away from China. I mean, they're hardwired in, so they can't move away from China, but new capital investments are heading to places like India and Vietnam. So we've got a very positive macro view, despite the fact that it's been one of the weakest markets this year. So there's a sort of top-down view, but also there's the special situation view that, as that top-down view gets greater acceptance, there'll be more demand, and this number of shares in issue is steadily being reduced, and therefore the demand and supply will reach equilibrium at some point, maybe in 3 months or maybe in 2 years' time. And at that point, they'll no longer be trading on 20 discounts, they might be trading on a 2 discount. So we do have long-only equity situation in the portfolio, but it's more difficult for there to be a mispricing opportunity if they're plain vanilla. The ones that we get involved in might be single country. Georgia Cat, which is an example, which trades on about a 60 discount, despite the fact Georgia being in a boom condition. It's border with Russia, I think, is the main problem. So the perception is very, very poor. And that's why it trades on such a deep discount. But also the net asset value, the value of the portfolio has been steadily rising, and people aren't really looking at it because it's not something that people very often would advise their investors to buy. A single country fund in Eastern Europe with a border on Russia that had a war with Russia in 2008. Sentiment can lead to some extreme discounts around.
Okay, maybe to go back to the beginning, you talked a bit about how trusts have changed over the years and how they have this long history and so on. You said you started working in the 1970s. I think a lot of people see parallels with the 1970s today.
Yeah.
First of all, would you say that comparison is fair? And also, can you talk about what maybe investors should expect in this sort of environment?
I mean, no slump or no recession is exactly the same, but there are parallels with the 70s, and I think the most important parallel was that we had the barber boom, which was again government spending money that didn't have, pumping cash into the system, sending the markets higher, and then eventually the markets crashing. I think we've had all that. I think. Probably economics, hopefully, is better understood by the current generation of politicians, or the ones that may be in number 10 and number 11 now. So I think what we will see, and this will be globally, as I said before, steadily draining of liquidity from the financial system to try and reduce these heroic amounts of money that have been borrowed and the amount of cash that's been pumped into the system. So the most likely scenario is just a very slow, because you can't do this quickly because the markets and the economies are fragile. So it's just that tide being against you in a relatively gentle way, but for an extended period of time. And I think if you look back when I first started at the end of the 70s, we were coming towards the end of that. I mean, I think the markets were dead in 79 and 80, but then kicked into gear, I think, in about 1981. People had given up on equities. There had been, a natural home for savings, but they'd performed extremely badly since the early 70s. So you've sort of had a lost decade that, that people had given up, and therefore, old-fashioned bear markets aren't like the crashes and that we've seen, but then tended to be just markets falling a little bit every day for years, and that's probably the scenario, and that's why I was suggesting you don't really want to be too close to indices, because then you just get everything. But of course, within that environment, there will be things like aircraft leasing that's in its own microclimate is actually quite bullish. So yes, an extended period of dullness really, which is probably not the message that I was wishing to give. But if you're going back to the 70s and you just look at what happened during the 70s, that's that's basically had a bit of excitement in 74, and then everything asleep for 5 years.
Okay. Well, I mean, maybe for the final question, are there any areas that you think? I know you can't mention specific trusts or anything like that, but are there any sectors that you think moving forward may start to look, already are looking attractive?
Yeah, I think. Well, we've touched on some. I mean, I touched on aircraft leasing. I think is worth looking. Um, Property, probably, as long as you're patient, in that the falls have probably overdone the falls that we're actually going to get. Similar in private equity as well. Trading on very, very deep discounts. We will see falling NAVs. Yeah, private equity and some of the sort of debt funds have quite high charges, and there is an opportunity at the moment because there is a number of the wealth management chains, for example, in their models can't have holdings that have got quite high charges, because that increases the level of charges they have to disclose in their own products now. So private equity and some of the debt funds, for example, which traditionally have quite high costs, are trading at very wide discounts because a certain proportion of their share register needs to sell because they can't disclose fees of that height. So some of these things are trading on sort of 35 discounts, even though they're performing really well and will continue to perform really well. So one of our themes is trusts that have got high IOCFs, as we call it, or high level of charges, because people are selling us those shares for non-investment reasons, and we do love it when people sell us their investments when it's not an investment decision. It's purely that they want to reduce the fees they disclose on their own products.
Great. Well, that's like a bit of a more upbeat way to finish in your previous answer. So.
There's always things you can make some money on. So that's the beauty of MyGo.
Great. Well, Nick, thanks very much for taking the time to speak to me today, and hopefully we can have you on again at some point in the future.
Brilliant. Much appreciated.
You've been listening to Trust Issues by Kepler Trust Intelligence. You can subscribe to the podcast on Apple Podcasts or Spotify. Remember to visit our website at trustintelligence.co.uk to keep up with all the latest research on investment trusts.